Every major financial crash of the last 100 years has followed the same sequence. Not a similar sequence. Not a rhyme. The same structural progression, repeating with almost mechanical precision. 1929 followed it. 1987 followed it. 2000 followed it. 2008 followed it. Different decades. Different technologies. Different excuses. But the underlying architecture never changed. That alone should disturb you. Because if history were random, if crashes were just accidents, acts of fate, or the result of human error, you wouldn't see this level of consistency. You wouldn't see the same warning signals appear again and again, sometimes years in advance, lining up like markers on a road no one wants to acknowledge they're driving down. Wall Street knows this pattern. The Federal Reserve knows it. The institutions that manage wealth for billionaires and sovereign funds absolutely know it. But most people don't. And that's not an accident. Because if ordinary people understood how crashes actually form, if they knew what to look for, they wouldn't panic at the bottom. They wouldn't sell after the damage was done. They would quietly step aside before the collapse, long before the headlines turned red. Today, I'm going to walk you through all 5 stages of this pattern. Not as theory. Not as opinion. But as a historically verified sequence that has preceded every major collapse of the modern financial era. And I'm going to show you exactly where we are in that sequence right now. Spoiler, we're further along than most people realize. In September of 1929, a man named Roger Babson stood in front of a room full of business leaders and delivered a warning that would ruin his reputation, temporarily. He said 9 words. Sooner or later, a crash is coming, and it may be terrific. The audience laughed. Newspapers mocked him. Wall Street dismissed him as a crank. The most celebrated economist of the era, Irving Fisher, publicly rejected Babson's warning, declaring that stocks had reached what he famously called a permanently high plateau. 47 days later, the market collapsed. Fisher lost everything. His fortune. His credibility. His legacy. He spent the rest of his life trying, and failing, to recover. Babson, meanwhile, went on to make a fortune. He later founded Babson College, which still exists today. But here's the part history books usually leave out. Babson wasn't guessing. He wasn't predicting based on intuition or fear or moral outrage at speculation. He had developed a systematic framework for analyzing financial fragility, one rooted not in price movements, but in structure. He studied credit expansion, market concentration, institutional behavior, liquidity conditions, and what he called trigger vulnerabilities. 5 forces. 5 stages. I spent months cross-checking his framework against Federal Reserve data, historical balance sheets, and academic research across multiple crises. It holds. Every time. Which brings us to stage 1, the point where every crash begins. Stage 1, the credit explosion. Crashes don't start with panic. They don't start with fear. They don't even start with speculation. They start with debt. Before every major collapse, there is a period where credit grows faster than the real economy can absorb it. Borrowing accelerates not because people are becoming more productive, but because rising asset prices make leverage feel safe. People borrow money they cannot realistically repay. They use that borrowed money to buy assets. Asset prices rise. Rising prices create the illusion of wealth. That illusion encourages even more borrowing. It feels like prosperity. But it's not. It's a feedback loop, one that rewards leverage, punishes restraint, and quietly transfers risk from institutions to individuals. In the late 1920s, this took the form of margin debt. Ordinary Americans were putting down as little as 10% and borrowing the remaining 90% to buy stocks. Factory workers, clerks, and school teachers were leveraged like modern hedge funds. By 1929, total margin debt had grown so large it was roughly equivalent to the entire federal budget of the United States. When prices rose, everyone felt rich. When prices fell, there was nothing underneath. In 2007, the mechanism changed, but the structure didn't. This time it was mortgage debt. Banks engineered financial products that allowed people to buy homes with no money down. Mortgages were packaged into securities, rated as safe, and sold to pension funds and insurers around the world. The leverage didn't disappear. It just became invisible. In 2000, it was corporate debt. Companies with no profits borrowed billions to fund expansion, using inflated stock prices as collateral. When valuations cracked, the debt structure collapsed almost instantly. Now look at today. Official margin debt sits around $750 billion. But that number is misleading. It captures only a fraction of the leverage in the system. Wealthy investors borrow against their portfolios through securities-based lending, adding hundreds of billions more. Options markets allow small amounts of capital to control massive positions, creating trillions in notional exposure that never appear in margin statistics. Corporate debt has exploded past $10 trillion, much of it not used to build factories or innovate, but to buy back stock, artificially boosting earnings per share. Government debt has surpassed $34 trillion, with interest payments now rivaling, or exceeding, core national spending priorities. Measured against GDP, total debt in the American economy is higher than it was in 1929. Higher than in 2008. Higher than at any point in recorded history. Stage 1 isn't a warning light. It's an inferno. But debt alone doesn't cause crashes. What turns vulnerability into catastrophe is where the risk accumulates. Which brings us to Stage 2. Stage 2, the concentration trap. Markets don't collapse simply because prices are high. They collapse because risk becomes concentrated. When a small number of assets come to represent a disproportionate share of total market value, the system becomes brittle. Fragile. Dependent on perfection. In 1929, the market revolved around a handful of glamour stocks. The most famous was Radio Corporation of America. RCA went from under $2 to over $500 in just a few years. Most investors had no idea how radio technology worked. They didn't need to. The price kept going up. RCA became a massive percentage of market capitalization. When it cracked, it didn't fall alone. The market fell with it. In 2000, concentration took the form of technology stocks. Cisco, Intel, Microsoft. A small cluster of companies dominated the Nasdaq. When they rolled over, trillions evaporated. In 2008, concentration hit inside the banking system. A handful of institutions held the vast majority of derivatives exposure. When one failed, the entire structure trembled. Today, the concentration is no longer hidden. It's mathematical. The top 7 stocks in the S&P 500 now account for over 30% of the entire index, at times closer to 35%. When most people buy diversified index funds, they aren't buying 500 companies. They're making an enormous, implicit bet on 7. And those 7 are priced for perfection. Not good earnings. Not strong growth. Perfection. Passive investing has amplified this effect. Every dollar flowing into index funds automatically buys more of the largest stocks, pushing their weight even higher. It works beautifully on the way up. On the way down, it reverses. And when it reverses, it does so mechanically, without judgment, without mercy. This is the concentration trap. And we are deeper in it than ever before. If stage 1 is about excess, and stage 2 is about fragility, then stage 3 is where the system reveals what it really is. Because this is the moment when the people who understand the risk start to leave. Quietly. Deliberately. Without warning anyone else. This stage makes people uncomfortable, Not because it's complex, but because it exposes an uncomfortable truth. Markets don't collapse when everyone is blind. They collapse when some people can see, and choose not to say anything. Stage 3, the smart money exit. Before every major crash, there is a period where institutional investors begin reducing exposure. Not dramatically. Not all at once. And never loudly. They sell positions incrementally. They raise cash. They hedge. They buy insurance. And at the same time, they tell everyone else to stay calm. They go on television and say fundamentals are strong. They issue reports saying volatility is normal. They reassure retail investors that long-term thinking is all that matters. What they don't say is that they are already preparing for the downside. In 1929, the largest banking families began liquidating months before October. Bernard Baruch, one of the wealthiest men in America, was almost entirely in cash by early autumn. Joseph Kennedy famously sold after overhearing a shoe shine boy giving stock tips. That story gets romanticized. But the reality is far more disturbing. Kennedy had access to information networks that most people didn't. He spoke to bankers, insiders, politicians. He didn't sell because a shoeshine boy scared him. He sold because he knew how unstable the system had become. Regular Americans didn't. They kept buying. They were the exit liquidity. In 2007, the same pattern repeated. Hedge funds began shorting subprime mortgages more than a year before the crash. Investment banks quietly reduced exposure. One firm, in particular, structured securities designed to fail, then sold them to clients while betting against them internally. Executives at major mortgage lenders sold massive amounts of their own stock while publicly reassuring investors. Homebuyers kept buying. Retirement accounts stayed invested. Pension funds absorbed the risk. Once again, regular people were the exit liquidity. Now look at today. Corporate insider selling has reached extreme levels. CEOs, CFOs, board members. The people with direct visibility into earnings, margins, supply chains, and financing conditions are selling stock at rates not seen in decades. The ratio of insider selling to insider buying is historically skewed. For every executive buying shares in their own company, multiple insiders are selling. At the same time, retail participation has surged. Index fund inflows. Retirement contributions. App-based trading platforms. Record exposure to equity markets among households. The direction of flow is unmistakable. Smart money is selling. Regular people are buying. This is not moral judgment. It's structure. Institutions don't panic. They position. And when positioning reaches an extreme, it tells you something about how risk is being perceived behind closed doors. Stage 3 doesn't mean the crash is imminent. It means the handoff has begun. From informed capital to uninformed capital. From those who understand the cycle to those who believe the narrative. But even this isn't enough to trigger collapse. Because markets can remain irrational longer than anyone expects. What actually breaks them is something far more subtle. Something most people misunderstand entirely. Stage 4, the liquidity illusion. This is the most dangerous stage, because nothing appears wrong. Prices are stable. Indexes are high. Trading volume looks healthy. From the outside, the system appears calm. But underneath, the structure is hollowing out. Liquidity, the ability to buy and sell without disrupting price, is the oxygen of financial markets. When liquidity is abundant, shocks are absorbed. Prices move gradually. Corrections feel manageable. When liquidity disappears, markets don't decline. They gap. They freeze. They break. In 1928 and 1929, the Federal Reserve tightened monetary conditions. Interest rates rose. Credit became more expensive. At first, nothing happened. The market kept rising. People concluded that tightening didn't matter. Then selling began. And when it did, there were no buyers. Prices didn't drift downward. They collapsed. The bids vanished. The crash wasn't emotional, it was mechanical. In 2007 and 2008, the pattern repeated. Rates rose. Credit tightened. Asset prices stayed high. Then Bear Stearns failed. Then Lehman Brothers. Suddenly, everyone realized liquidity had already disappeared. The market fell more than 50% in months, not because fundamentals changed overnight, but because the plumbing failed. Now look at today. Interest rates have risen at the fastest pace in 40 years. From near zero to over 5%. In less than 2 years. At the same time, the Federal Reserve has been running quantitative tightening, removing hundreds of billions of dollars from the financial system. And yet markets remain near all-time highs. People interpret this as resilience. It isn't. It's delay. In March 2023, 3 major banks failed in a single week. Not obscure institutions. Systemically important ones. They collapsed because rising rates destroyed the value of long-duration assets, creating liquidity crises. The response? Emergency lending facilities. Backstops. Quiet interventions. Liquidity was injected, just enough to prevent immediate collapse. But the underlying pressure didn't disappear. It just went underground. Even the Treasury market, the deepest, most liquid market in the world, has shown signs of strain. There have been moments where trading depth nearly vanished. When the most liquid market on Earth starts experiencing plumbing problems, that's not a footnote. It's a warning. Stage 4 is where danger becomes invisible. Everything looks calm. But the oxygen is already leaving the room. And when liquidity is gone, all it takes is a spark. By the time the system reaches this point, the outcome is no longer in doubt. The debt is already excessive. The risk is already concentrated. The smart money has already moved. The liquidity is already draining. The structure is fragile. What remains is timing. And that brings us to stage 5, the most misunderstood stage of all. Stage 5, the trigger event. This is where most people get the story wrong. They believe the trigger causes the crash. It doesn't. The trigger merely reveals what was already broken. Think of it like an earthquake. The quake doesn't create the fault line. It only releases the tension that's been building for years. Stages 1 through 4 create the fault line. Stage 5 is the moment it snaps. And the reason this stage is so dangerous is precisely because it cannot be predicted. If you could predict the trigger, markets would price it in. If everyone could see it coming, it wouldn't work. The trigger is almost always something that looks minor, distant, or irrelevant, until suddenly it isn't. In 1929, the trigger wasn't a collapse in American industry. It wasn't unemployment. It wasn't falling earnings. It was a relatively obscure financial scandal in Britain. A financier named Clarence Hatry was arrested for fraud. Most Americans had never heard his name. The case seemed irrelevant to U.S. markets. But British banks had exposure. They needed liquidity. So they sold American assets. That selling created more selling. And within weeks, the most powerful economy in the world entered the Great Depression. The fraud didn't matter. The fragility did. In 2008, the trigger was Lehman Brothers. But it could have been Bear Stearns. Or AIG. Or any number of highly leveraged institutions. The system was already unstable. Lehman was just the spark that hit dry timber. So what will the trigger be this time? No one knows. And anyone who tells you they do is lying. It could be geopolitical, an escalation around Taiwan, a miscalculation in Eastern Europe, a sudden shock in the Middle East. It could be financial, a major hedge fund collapse, a derivatives failure, a sovereign debt crisis. The global derivatives market is measured in the hundreds of trillions of dollars in notional exposure. One major counterparty failure could cascade across institutions faster than regulators can react. It could be banking related, another wave of regional bank failures, or stress in commercial real estate that overwhelms lenders. It could be political, a debt ceiling crisis that goes wrong, a constitutional standoff, a sudden loss of confidence in fiscal governance. Or it could be something no one is watching. That's usually how it happens. The trigger is never the thing everyone is worried about. It's the thing that feels too small to matter, until suddenly it matters more than anything else. Here's the part that should make you pause. Historically, once all four preceding stages are active, the trigger tends to arrive within 12 to 24 months. Not because anyone schedules it, but because systems under stress don't remain stable indefinitely. We've had clear confirmation of stages 1 through 4 since late 2024. That places the window somewhere in 2025 or 2026. Not a prediction. A probability band. Now let me be very clear about what this does not mean. It does not mean the market will crash tomorrow. Timing markets precisely is impossible. Markets can remain distorted longer than logic suggests. It does not mean you should sell everything, hide in cash, or panic. That's not preparation. That's fear. What it does mean is that the conditions that preceded every major crash of the last century are now present. Simultaneously. At extreme levels. This is not normal. This is not background noise. This is not business as usual. Which brings us back to Roger Babson. Babson didn't just warn about the crash. He prepared. While others borrowed aggressively, he reduced leverage. While others chased stocks at peak valuations, he held cash. While others assumed the system would protect them, he assumed it wouldn't. When the crash came, he wasn't destroyed. He was positioned. Irving Fisher, the brilliant economist who mocked Babson, was not unintelligent. If anything, he was too confident. He believed the system was more stable than it was. And that belief cost him everything. The difference between them wasn't intelligence. It was respect for the pattern. You faced the same choice. You can look at this data and decide it doesn't apply to you. Markets always recover, right? This time could be different. Or you can ask uncomfortable questions. How much of your wealth is tied to equity markets? Not just your brokerage account, your retirement, your pension, your home equity. How much of that exposure is concentrated in a handful of megacap stocks? How dependent is your future on prices staying high? If markets fell 50% over the next 18 months, as they did in 2008, what would that mean for you? Would you be fine? Or would it erase a decade of progress? I'm not telling you what to do. I'm not a financial advisor. I'm a historian. I study patterns. And the pattern is clear. The people who get destroyed in crashes aren't foolish. They're unprepared. They trust experts who tell them everything is fine. They assume someone will warn them if something is really wrong. No one warned people in 1929. No one warned people in 2008. No one is going to warn people now. The warning isn't a headline. It's the pattern itself. And now you've seen it. What you do next is up to you. There is a sentence that appears, in different forms, before every major financial disaster. It sounds reasonable. It sounds mature. It sounds responsible. And it is always wrong. This time is different. Not because people are stupid. But because the system trains them to believe it. By the time all 5 stages are in motion, the narrative machine is already working at full capacity, designed to calm, reassure, and delay reaction just long enough for positioning to finish. This is the phase where logic fails not because data is missing, but because belief overrides it. The final illusion, normalcy. In late 1929, even as credit tightened and insiders sold, newspapers ran headlines insisting the worst was over. Banks assured depositors that fundamentals were strong. Economists spoke confidently about productivity gains and a new economic era. Politicians praised the resilience of American industry. The crash didn't feel inevitable. It felt impossible. In 2007, the same thing happened. Home prices had never fallen nationally before. Risk models said diversification made the system safer. Central banks claimed they had learned from history. When cracks appeared, they were dismissed as contained. They never are. Here is the most dangerous belief of all. That modern systems are smarter than old ones. That algorithms replace cycles. That technology cancels human behavior. That central banks can override leverage indefinitely. They can't. They can delay. They can distort. They can transfer risk. But they cannot repeal structure. Debt still compounds. Liquidity still evaporates. Confidence still collapses faster than it's built. Every intervention trades future stability for present calm. And the longer that trade continues, the more violent the eventual adjustment becomes. Look at the psychology of late-stage markets. People aren't euphoric anymore. They're anxious, but invested. They don't believe markets are cheap. They believe they have no alternative. Cash feels dangerous. Bonds feel broken. Housing feels unaffordable. So they stay where they are. Not because they're optimistic. Because they're trapped. That's when systems are most fragile, not at the peak of excitement, but at the peak of dependency. This is where history becomes unforgiving. Because once confidence cracks, it doesn't leak out slowly. It collapses vertically. Liquidity disappears. Correlation goes to 1. Assets that were supposed to hedge each other fall together. This is why diversification fails during crashes. Not because it's flawed in theory, but because it depends on liquidity that no longer exists. Why no one will save you. There is another comforting myth that appears before every collapse. They won't let it happen. They, being central banks. Governments. Regulators. Institutions. But history is clear. They don't prevent crashes. They manage the aftermath. In 1929, the Federal Reserve hesitated. In 2008, they reacted, after the damage was done. Intervention doesn't stop collapse. It socializes losses after private positioning is complete. Bailouts protect systems, not individuals. Liquidity flows first to institutions closest to the source. By the time it reaches the public, prices have already adjusted. That's not conspiracy. It's plumbing. This is the point where people usually ask. So what should I do? And this is where most videos fail, by giving advice instead of understanding. I'm not here to tell you to buy gold. Or sell stocks. Or hide in cash. Those are tactics. History isn't about tactics. It's about positioning relative to fragility. Babson didn't survive because he guessed the exact timing. He survived because he reduced dependency on a single outcome. He didn't need the market to go up. He didn't need the system to work perfectly. He needed optionality. Most people today have none. Their retirement depends on markets staying high. Their housing depends on rates staying low. Their job depends on credit staying cheap. That's not stability. That's leverage, whether you call it that or not. The tragedy of crashes isn't that they happen. It's that the signals are visible, and ignored. Every person wiped out in 1929 had access to the same information as Babson. They just trusted the wrong narrative. Every person wiped out in 2008 heard the same reassurances you're hearing now. They just believed the system was more robust than it was. History doesn't punish ignorance. It punishes denial. And that brings us to the final question. Not, when will the crash happen? But, what happens if you're wrong? If you prepare and nothing happens, you miss upside. If you don't prepare and you're wrong, you lose decades. That asymmetry is the real lesson of history. And it's the lesson most people only learn once. By the time the crash arrives, the decision has already been made. Not by markets. Not by central banks. But by individuals, quietly, months or years earlier. History doesn't announce its turning points. It records them after the fact. And when you study every major collapse, not just the numbers, but the human outcomes, the dividing line is always the same. Not intelligence. Not education. Not access to information. Preparation. In the aftermath of 1929, millions of lives were permanently altered. Retirements vanished. Savings were erased. Careers ended overnight. And yet, a small minority didn't just survive. They rebuilt faster. They accumulated assets while others were forced to sell. They emerged with influence instead of debt. What separated them from everyone else wasn't foresight of the exact moment. It was respect for the pattern. Roger Babson didn't predict the future. He acknowledged structure. He understood that when debt, concentration, insider behavior, and liquidity align, systems don't correct. They reset. While others chased the final gains, Babson stepped aside. While others borrowed, he reduced leverage. While others trusted narratives, he trusted math. And when the reset came, he wasn't scrambling. He was positioned. Irving Fisher, by contrast, believed brilliance could override cycles. He believed productivity and progress had permanently changed the rules. He believed stability was guaranteed by intelligence. History proved otherwise. This is the part no one wants to hear. There will be no warning siren. There will be no official announcement. There will be no moment where authorities say, now would be a good time to step back. By the time fear becomes obvious, positioning is already complete. Liquidity is already gone. And decisions made in calm determine outcomes in chaos. What makes the present moment unique isn't the risk. It's the scale. Never before has so much retirement security, housing wealth, and institutional capital been so tightly tied to a narrow set of outcomes. Never before has leverage been so embedded, and so invisible. And never before have so many people been told, repeatedly, that caution itself is irrational. That's not progress. That's late cycle psychology. I'm not here to tell you what to buy. I'm here to remind you of something far more important. No system is designed to protect everyone. Every financial architecture distributes pain unevenly. Those closest to liquidity survive first. Those farthest from it absorb the loss. That's not cynicism. That's history. So here is the only question that matters. If the next 18 months look like 1929, or 2008, or any of the collapses that came before, where will you be positioned? Not emotionally. Not ideologically. Structurally. Will your future depend on everything going right? Or will you have room to absorb what history has shown, again and again, eventually goes wrong? The crash of 1929 didn't destroy lives because people were foolish. It destroyed lives because people believed stability was guaranteed. The signals were visible. The pattern was clear. People chose not to see it. You don't get to choose whether cycles exist. You only get to choose whether you respect them. Now you've seen the pattern. What you do next is up to you.